Welcome back to the Private Markets Outlook series from Future Standard. Today, we are discussing what lies ahead for commercial real estate with two of our portfolio managers. The past 5 years in real estate could best be described as a roller coaster, and investors would be forgiven for experiencing whiplash. First, the pandemic forced a rethink of entire property types, especially office. Then came a boom, with values jumping more than 30% in just 18 months. And just as quickly, the Fed's rate hike slammed the brakes, triggering one of the most challenging periods for the asset class in decades. Property values fell, transaction activity dried up, and performance went negative for 2 years. Now, in September 2025, the market feels steadier. Prices have stopped falling, activity is creeping back, but investors are still cautious. It's not the chaotic ups and downs of recent years. And maybe that's the best news. In our mid-year private markets outlook, we argued that higher for longer rates have reset the opportunity set. But the real story is how those shifts are playing out on the ground. So today, we're bringing in two of our top real estate investors. We'll be talking to Rob Lawrence on credit later on to share what he's seeing on the ground. But first, let's talk to Jason Landon on the opportunities in real estate equity. And we're pleased to be joined by a very special guest. He's a managing director and head of real estate secondaries here at Future Standard. Jason Landon, thanks for joining the show.
Thank you, Alan.
And to start, Jason, could you give people some sense of your background? You've got decades of experience in the real estate market. There, you've allocated hundreds of millions, billions of dollars of capital over the course of your career. How did you get to this point? And what have been some of your formative experiences as a real estate investor?
I've been with the firm for almost 24 years and been with the program since we launched it. So when we first launched the business, we launched it basically on the backbone of the private equity business. And we did so by advising institutions with their private real estate portfolios. So doing the investment pacing models, sourcing and underwriting managers, and all of that led to developing extensive relationships in the marketplace. So that takes us back to 2002. Then we had the GFC. And with the GFC and that significant market disruption, that created an opportunity to pivot and start executing in the secondaries market. Again, something that we had been doing in private equity dating back to 2002. So that created a great opportunity to use our GP relationships, our information advantage to quickly pivot and provide a solution to the marketplace, namely in LP secondaries. We then extended further our strategy to look at our GP relationships and how can we be more strategic to them. We started doing direct co-investments. So that's a big part of what we do. And so when you fast forward to where we are today, I'm leading a team of 5 professionals. We're doing the same type of investment activity in secondaries and co-investments. But in today's environment, we're really focusing on income-oriented opportunities. We think the core plus space is providing some of the best risk-adjusted opportunities today, where the market has been repriced and the need for liquidity. That's where we want to be playing.
So, Jason, it seems, first of all, it's very interesting the birth of real estate secondaries coming out of a lot of the private equity expertise that the firm had, around the GFC, and we're going through the other end of a similar CRE correction, obviously for different reasons. But it seems like most people agree that that's come to an end, at least in, many of the ways that we think about it. Property values have stopped declining, activities improving, albeit slowly, and fundamentals have at least stabilized and are improving in some sectors. But there seems to be perhaps a lack of consensus, about what type of market environment comes next. At a high level, how would you describe, where the market is headed, and how does that compare with, say, a year ago?
Well, first, taking a step back and looking at the last 3 years, it's been a challenging 3 years, but over that time, a lot has happened. The market has adjusted, expectations have adjusted. So I think you need those two elements first to kind of get to the other side and start, thinking about a recovery here. And so, with the expansion of cap rates, with an expectation by investors and market participants of higher for longer, I think that sets the foundation, right? And all along the way, you've had fundamentals that have continued to improve. So, we did have a significant, in addition to, the rapid rise in rates kind of back to normal, you also had on the back of that a huge addition of supply. So, that led to the challenges that we've all been facing. But now, and you've all have written about this, fundamentally, as we look forward, that supply pipeline is really dropping off. Demand has remained resilient. So, that all feels pretty good. And then you look at the indices. You look at, the Odyssey Index, for example, and that's an index that is widely accepted across the marketplace as an indication of where private real estate is. It's the open-ended core index for real estate. And after 2.5 years of negative returns, this year it turned positive. So, and once it turns positive, it tends to stay positive. So I think when you look at all those elements, the survive till 25, discussion that took place, but we're here. It's now 25. It's third quarter 25. I think people might have, when they were saying that, felt it was going to look and feel different than it does. But there has been a lot of progress in the marketplace, and I think some of the why you're asking the question, why isn't there consensus about where we are? It's still taking time. Transaction volume still isn't back to normal, but again, we're getting there. And then for investors, they still aren't seeing those distributions fill their inbox or their bank account, so they're in need of that. But it's all coming. It's just taking time.
Yeah, I love how you phrase that, Jason. And when we think about like the interest rate environment, right? Like I think of I would call it normalized interest rates, but higher interest rates, however you want to, slice it, they sort of act as a constraining factor, right? We came into this year across private markets. I think a lot of people expected the animal spirits to come back, right? For sort of deal volumes to explode in buyouts and in real estate and in other parts of the market. That's not what we've gotten, right? Part of that's been policy uncertainty, right, on the sort of government side. But part of it is just that interest rates have sort of stayed elevated, right? And I think the reality is you've got, elevated or positive real interest rates for the first time in a long time. And that creates a sort of friction that means that the recovery that we're seeing is going to be more gradual, right? And, I think in our view, absent some more meaningful slowdown in the economy, we think interest rates stay higher than they were during the 2010s, into the future. Obviously, we're recording this September 12th on a Friday. The Fed's going to likely cut rates, by the time this podcast comes out, and the bond market's reacted to that. But, as you're thinking about the impact of interest rates, and obviously real estate's an incredibly interest rate sensitive, part of the market, how are you underwriting deals today relative to maybe, 6-7 years ago? How are you looking at the sort of interest rate risk, and how are you baking that into your assumptions?
A lot there, Andrew.
There is.
But I think it all starts with our approach to underwriting and where we're focusing in the marketplace today. So what you're laying out there and what it says to me is where rates are, where cap rates are. The levered IRR is more challenged than the unlevered return, right? So and our focus on income and income growth, the reset in values. When we're underwriting real estate, we first start with where are the greatest demand drivers? Where is the greatest potential for income growth? And then obviously we want to be acquiring assets at a discount to replacement cost to protect on the downside. And we don't know where cap rates are going to be at the end of the day. We can only run sensitivities. And so what the approach that we take is we effectively underwrite two scenarios. We did before, we do now. And those scenarios are, hey, if we're in a higher for longer scenario, we want to be in property sectors and markets that are going to participate in excess growth. And so under that scenario, those assets will continue to perform because they're going to generate that income growth. So we'll get unlevered yields or yields on cost that are greater than 7%, even upwards to 8% in some situations. And then on the downside, if we're doing our job right and we're focusing on these sectors, these demand drivers that have those strong drivers behind them, then if the economy starts to soften a little bit, guess what? Well, first of all, we're coming in at a much better basis. Yep. First off, and then secondly, it should be very durable. And we do have leases, so it's not unless you're doing hospitality, which is not a big focus of ours, right? We do have some term here embedded where we can take advantage of that, and then as those roles participate in the growth. So we underwrite kind of higher for longer, or in a scenario where the economy shows some weakness, and what does that look like?
Yeah, that's really interesting, and I think you've probably said the word income, or we have probably said the word income, 5 or 6 times already. I think you look back to the 2010s period where you did have this sort of rising tide lifting all ships, right? Where cap rates were following interest rates lower. That allowed sort of this what I would call beta price appreciation across most of the market at least. That's different now, but I think on the upside, to your point, asset yields are higher, right? Cap rates are higher, and that means your starting income, asset yield is higher. So, as you're looking around the market and you talk about the need to sort of source durable, income generation, what parts of the market are you seeing where you think that is most attractive today?
Yeah, I mean, what we're focusing on are opportunities that have high cash flow, low capex kind of profiles. So, and I was just at a conference, and there were surveys done about where people think we are in the market, what are they most interested in, and no surprise, industrial continued to kind of be at the top of the chart. And industrial is there, the niche sectors are there, but I think where we are today and the opportunities to invest today, you got to peel back the onion a little bit, because when you say industrial, there's a lot of segmentation within that property sector, right? So where we think there's the most compelling opportunities today is kind of shallow bay, light industrial. It's had less deliveries in terms of supply. It's very hard to deliver that type of product where it makes sense. And you can really see, releasing spreads are quite positive. And they're participating in the broader economy with great diversification of tenancy. So, that's where we like the most, Andrew. But there's opportunities beyond that in the residential sectors. You mentioned triple net lease, is something with elevated yields that has been very attractive. So, but top of the list, I'd put industrial there.
Sure, and maybe a quick add-on, and maybe for my own interest. What makes a good real estate operator? I mean, you said you guys are focused on core plus type of properties, low capex, but what makes a good owner and operator of a real estate property?
You got to buy well, first of all, right? You only get one shot at your basis, so you got to get that right first and foremost. Secondly, you got to be able to lease. You got to be able to create, income growth. Again, cap rates on the back end, the market will take care of that. But if you get that income growth, it's going to be tough to be disappointed. So, we look at, and then I guess, finally, you got to be a disciplined seller. So, some of these people and the lessons learned that we've seen in this marketplace, for whatever reason, holding for last dollar or disappointed with value, holding on to assets, and they become more disappointed in some cases. So, we want to see, the buy well, operate well, and then be a disciplined seller. And on the operation side, I mean, something that we always do when we're looking at, the sponsors that we're partnering with is look at the returns they've generated historically and apply some attribution. How much of it is from cap rate compression? How much is it from income growth? So we try to dissect that and say, hey, what was your NOI at acquisition? What was it at sale? And see, did they rely on the market? Did they just buy well? Or could they actually operate?
Jason, you're talking about the importance of operation, and one of the things I appreciate about this business is we have such a vantage point, on the economy and kind of how things function, and then we take it out and we live our real lives, and a lot of times we see them kind of bleed in. And I just moved with my wife, from an apartment building. And a big part of the reason why we left was because the property management teams operating the building, just left so much to be desired. I mean, we felt like we weren't treated well.
Full disclosure, I've lived in the same building, and I can firmly agree with that.
I didn't have AC for an entire month last summer, and we're sitting there, and it's like, it's a great, wonderful property, and it's being managed terribly. Like, I'm like, their GP who owns this property has got to not be happy with how this is being run. It just struck me because it's like, even at an individual level, this operator importance, like, it plays down into, like, Andrew and I both don't live there anymore.
Yeah.
It has a real impact.
Alan, great point. And I make the analogies, like, you go to a restaurant, it's got great food and terrible service.
Mm-hmm.
What's harder to deliver?
Yeah.
Is it on the food side or the service side? Like you got to get that right. It's a no-brainer.
Mm-hmm.
And, we were just with an operator recently, and they talked about having a hospitality mentality in terms of their operations and how they go about leasing. And number one, you got to have the ability, you got to be able to, to spend the capital, spend it in advance to maintain the property and to get the leasing done that you want to get done. And then you got to treat your tenants properly. You got to give them the attention and make them want to be there. And in a competitive environment, that's the difference, So, and you can't rely on the broker as an operator. Mm-hmm. You should be there alongside the broker, and you don't want to be outsourcing that activity because it's the most important activity you can possibly do, right? That's where the value is generated. That's where the income growth is generated. So if you're outsourcing that function, or you're not getting it right, or you're not making your tenant feel important, I think that you're not going to get it done at the end of the day.
I think Jason's right. I think maybe I did just want a little attention.
Yeah, no, I mean, hey, don't we all?
Yeah,
don't
absolutely.
So, we've talked a lot about the market here from sort of a high level, Jason. Obviously, I think we agree that, prices have reset. We've got sort of stabilized normal cap rate levels. Fundamentals, I think, in most sectors look like they're improving right now. The supply, sort of wave that we got is coming to an end. A lot of good opportunities to drive strong income and income growth within the real estate market today. What are the best opportunities you're seeing and that investors are seeing to actually access that opportunity?
Yeah, and I would add, so one other thing to overlay there, Andrew, which creates the opportunity, is you still have illiquidity,
right?
From an investor's perspective. So when you look at the open-ended funds, the queues remain. They've extended well beyond where they were in the GFC. Now they've come down a bit, but they're still there, and they're at elevated levels. When you look at the closed-end market, and you look at DPIs for the vintages of 2018, 2019, nowhere near where they would be in a normalized market if you modeled it out. So, that's the opportunity in the secondary market. If you can be a solutions provider to GPs and LPs, by the way, right? So GPs, fundraising hasn't been all that easy, especially for the operators that we were just talking about, even the good ones. So, and do they want to hold on to their better assets? Sure. So if they can recap them, participate in this income growth going forward in this next phase of the cycle, there's ample opportunity to do that, and that opportunity is growing substantially. I think as values, have adjusted, and we'll still see some more value adjustments, by the way. So even though we feel confident about where we are in the market, that we're kind of getting to the other side here, that doesn't apply to every asset, and you'll still hear of news of assets trading hands and disappointments across the board. But when those values have adjusted to the point, LPs, I think, will tap into the secondary market. So if you can use the secondary market to access these opportunities and create an even better and more compelling basis and participate in the recovery and the income growth, that's where we think there's an interesting opportunity.
Jason, one of the things I heard you say there is, the market's kind of calming. And I think a good way to kind of tie this up is, the market's become calmer, but not comfortable. Like you said, there may still be valuation changes that occur, but the market has gone through a phase where it's really gotten back to normalization. And I think that's one of the big takeaways for us here is, hey, look, we're back to square one. Now it's being a real estate investor like you have been for the entirety of your career, focusing on income growth, quality properties, buying at attractive prices, and finding the best way to enter into those assets. So, Jason, your lessons you've shared today and the experience and insight on the market has been invaluable. So grateful to have you join the podcast, and hope you come back and join us again.
Great. Thank you very much, Alan and Andrew. And by the way, Alan, I think I'm going to use that. So calm but not comfortable. So I like that.
I like it. Thanks, Jason.
Thanks, Jason.
The mandate for private markets is to deliver alpha, and investors will need to dig beyond the surface level to find it going forward. Read the complete mid-year private markets outlook from Future Standard. Click the link in the description to download.
That was our conversation with Jason Landon, head of real estate secondaries here at Future Standard. And now we talk with Rob Lawrence, head of real estate credit. Joining us on the podcast, it's Rob Lawrence, our head of global real estate credit. We're excited to have him share his background today. He's got over 20 years of experience in the real estate lending business. Somebody that we're excited to learn from today, lessons that he's learned in his career, parts of the market that are interesting to him today. So Rob, welcome to the podcast, and please share a little bit about how you got here today.
Great. Thanks for inviting me. I really appreciate it. So I started my career during the savings and loan crisis in the early 90s and learned quite a bit from that. Over the course of the years, I transitioned to the CMBS area with Bear Stearns and then later JP Morgan Chase, and have been through quite a number of different interesting crises along the way, which I'm happy to go into more. Been with Future Standard since 2017, and we navigated successfully several crises in the market here, including, as you know, COVID and the run-up in rates and other more minor issues over the years.
And, that really brings us to an interesting point in the real estate market now. Most folks would say that the market has made its way through the worst of the correction that we've had most recently. And we would really agree with that. But at the same time, property values are sort of flat over the past year, and capital markets activity, hasn't really ramped yet. So, how would you characterize where we are in the market cycle right now, and where do you expect things to go in the next 6 to 12 months?
I feel like we've come through the worst for sure. The year got off to a good start, and then with the Liberation Day, there was a market pause with the capital markets in other areas, right? So for a couple of months, it probably set us back. The market, meaning the real estate market, capital markets, about 2-3 months, and we've come through that really well. We have we're looking at a very strong year end, and I think next year is really going to be a year where things start to happen as rates begin to come back. There's a lot more interest. There's a lot of dry powder sitting on the sidelines, both on the debt and equity side. So I'm pretty excited.
So, an activity comeback that's maybe been delayed but not denied. So, obviously, Rob, you focus on the credit side of the business. I think most folks who are listening are probably more familiar with the equity side of real estate. As we mentioned, you run one of the largest commercial real estate private credit vehicles in the market today. Obviously, as you mentioned, you've got a diverse set of experiences from distressed credit to the CMBS market. So you've got this sort of unique perspective across the different areas of the real estate credit markets. It's just sort of a two-part question. So first, throughout your career, can you kind of walk us through how the commercial real estate credit markets have changed? And, to remind folks, this is a $6 trillion market. It's a massive, massive market. How it's sort of changed and morphed throughout your career. And then relatedly, what role have those changes, especially post-GFC, what role have they played in, the fact that the capital markets held up much better in this past sort of crisis, as you mentioned, than they did, say, in the GFC and previous crises?
I've been fortunate enough to be in the market since the inception, really, of securitized products in commercial mortgages. Really, it was a little bit before I got into it, but it was very small, and so I was front and center coming out of the S&L crisis into a time when investment banks were aggregating commercial mortgages and securitizing them, right? So that grew, as everybody knows, or most of you know, significantly, through the 90s and then the 2000s. Within that, though, there were some major bumps in the road. So when the GFC happened, obviously took out every player for a period of time, and what was left after that, as coming out of the GFC, were really the big banks in the securitized products area. So most of the smaller players just went away or went out of business, weren't there anymore, right? And the loans that are being made by the investment banks and then securitized is they did one thing pretty well, or two. They got higher leverage. They had term, right? What wasn't so great was the lack of flexibility on those loans. So you couldn't pay them off when you wanted to. You couldn't modify them, upsize, downsize them, reamortize, none of that. So there was definitely an area of the market that needed to be covered by a different source of capital. And what we saw is private credit vehicles coming to be, which offered borrowers more bespoke financing terms that gave them flexibility to add value to their properties as needed, and then when they were done, pay off that loan in a much less costly way.
Right. So basically what we've seen is we've gone from a market that was sort of dominated by less flexible, less dynamic players like banks and the securitized markets to a more diverse, more robust lending market. Is that sort of a fair statement?
Yeah, yes, and also most banks don't like holding real estate loans for extended periods of time, and use their balance sheet strategically. Because of all the regulatory risk-weighted capital requirements and the Basel III. So it all comes back to what the private credit vehicles offer is something that is very hard for the banks to do.
Right. So that's a great overview. I think let's maybe bring it from high level down to the ground level. Obviously a key aspect of this cycle has been significantly higher financing costs. That's sort of the defining feature of the past, call it 3.5 years. The cost of a commercial mortgage is, depending on the product, maybe 200 to 400 basis points higher today compared to the 2010 to 2021 period. Right. And, as a lender, when you're looking at deals, that's great because it allows you to drive better income for your investors. But I imagine on the other side, it also tightens the margin of error for borrowers, right? So when you're underwriting a credit today compared to, say, 6 years ago or even 4 years ago, what's changed in your process, if anything?
Because I have been in this so long, I would have to say not that much, because rates were artificially very, very low for a very long period of time, and a lot of people got used to it, right? Lenders, borrowers, kind of everybody got used to it, and that's not normal though. That's not a normalized rate environment. So, we always look at, debt yield, loan to value, debt service coverage ratios, and we always look at things on a normalized, stabilized basis with, rates included. So I would say not a ton. Okay. I think since the GFC, there's been a lot more discipline in the market overall. With structure, and structure is always one of the most important things. The most important thing being the borrower.
Can you explain, just for our listeners, what you sort of mean by structure?
Sure. Starting with the capital structure first, and making sure that there's real equity in there in front of you that takes the first hit. Equally, if not more important, though, is the sponsorship group that you're lending to, and do they have the experience, the track record, and frankly the trustworthiness that you want to do business with that group. And sometimes it's not always the biggest. Many times it's not always the biggest of the borrowers that will leave the lender with the best outcome if things don't go as planned.
Sure. So, Rob, right now I think is an interesting time in the economy, right? As you mentioned, I think the Fed is expected, we're sitting here on September 11th, The Fed is going to meet next week. We expect they'll probably reduce interest rates. That's a positive, I think, for the market as a whole. I think it should reduce frictions and hopefully, open up some opportunities for activity to increase. On the other side, there's also some signs that the economy is slowing. The labor market has softened a bit. What are you seeing real time from your borrowers from sort of a cash flow perspective? Are these borrowers, are these properties still performing as you expected when you underwrite the loan?
So we're seeing most properties perform better than they were a few quarters ago. And I think you have to look at real estate as a local business. Yes, there's obviously the macroeconomic factors, rates being the biggest factor, and unemployment and that sort of thing. But at the end of the day, it's local. And, so we focus on growth markets. Markets that can absorb the supply that had been built, and as a lot of people know, there was a lot of excess construction done in heavy growth markets, right? And a lot of that's been absorbed and is being absorbed, and there had been a lot less new construction in the last couple of years due to the lack of capital, right? So as that's absorbed, we feel very good about the fundamentals, particularly on housing, multifamily, even single-family rentals, very strongly, because rents are going to be going up. The things we've talked about in the past, and home ownership, being, even if rates come down, it's still a rather expensive prospect, not just with the rates, but the down payment, and the fact that people these days do tend to like to be a little bit more mobile, less tied down, and it's just a different, it's a different market than it was.
I think multifamily.
That's a great segue.
That is.
Yeah.
I mean, multifamily and industrial have obviously been the hot property types. You can probably add data centers in there today. I'm going to put you on the spot. Give me one part of the market right now that you think that investors or the market writ large is underestimating. Maybe pricing is too wide relative to what you think the risk is. Where do you think there's opportunity lying in wait in your mind?
Well, I think that some office opportunities are excellent opportunities now, but you have to be very, very careful with those, right? So we think that something well located, that's walkable, that's heavily amenitized, that has, the way I describe it is, you look at it and you get it right away. There's not a story. Nobody's really in the mood for a story with any kind of office asset, and I don't care what fund you're talking to. That's just like typical. Look, for years, way before any of these. The interest rates or even COVID or any of this, suburban office has been sort of the butt of jokes for many years in the institutional real estate investing community. And, that's a little unfair because there are pockets that are good, but those are areas where we stay away from commodity product, whether it's office or it could be, a cookie cutter limited service hotel that are really fairly cheap to build, and we stay away from where land is cheap. Look, it goes in cycles. For years, retail was hated, especially malls. And frankly, most malls are not going to make it, and I think everybody knows that. But they're not all the same, right? So 100 or 150 of them, they would not only make it, they're going to thrive. So I think. And I'm not suggesting malls, but areas around malls that are good. I think there's other things that could be added around malls. Retail in general, I still like the grocery. Again, these are nothing unique, but it really does just come down to location, access, population growth, and employment in that local market. And of course, as I said, I keep coming back to who's the borrower.
Yeah, and I love this idea as we close it out that like we're going from a world, to your point, the 2010s were an anomalous period from an interest rate standpoint. And it really was like a, rising tide that lifted all ships. Obviously, you had some exceptions to that, the malls being one. But now we're really in a market with elevated financing costs where it's going to be an asset by asset, operator by operator type of market.
So with that, Rob, thank you for sharing your experience. Find that exciting in terms of the opportunity set that you see attractive. Again, it always comes back to asset specific. It needs to make sense. I love the way that you put that. So thanks again, Rob, for joining us and sharing your expertise with us.
Thank you very much.
Rob.
Andrew, we just had two amazing conversations with leaders on our real estate investment team here at the firm. Jason Landon, the knowledge that he shared with us. Rob, the same. The many years of experience through so many different periods of turbulence in the markets.
Yeah.
What are your kind of big takeaways from those conversations?
Yeah, it's interesting to hear them sort of compare this previous correction to other downturns in the real estate market that they've seen throughout their careers, whether it be the GFC or Rob mentioned the S&L crisis back in the early 90s. And I think clearly this correction was profoundly different, and I thought it was interesting that they both had similar answers as to we think this correction is over, right? Property values have probably troughed in most parts of the market, but what lies ahead may be different than what we've seen before, right? And I think if we kind of bring this back to our private markets outlook, the report that we released a month or two ago, when we think about the defining trends we talked about, right? And that was sort of the flow of capital, the constraints on fundraising, the flow of capital into the mega funds, higher for longer interest rates and what that means. And then sort of this broad uncertainty around, policy, deglobalization, things like that. I think there were some really interesting points there that they made in relation to those trends, right? So on the flow of capital side, we didn't really get into the concentration aspect, but we did talk about, the lack of liquidity, right, on the equity side and sort of the lack of distributions that investors are experiencing. And I thought it was really interesting to hear Jason sort of run through the secondaries opportunity, an opportunity to be a liquidity provider into that type of environment and enter at really attractive bases. I think on the higher rate side, it's that's where I'm really glad we had someone from credit and someone from the equity side because higher rates do introduce a different market environment. On the credit side, Rob mentioned, we asked him, how are things different today? How is your underwriting different today than it was maybe 7 or 8 years ago? And he said it's not really.
Yeah,
right?
Surprising answer.
Yeah, but I think when you get down to it, right, credit is about mitigating downside.
Right.
And you're looking at these metrics, right? Loan to value, debt service coverage ratio. You're looking at how likely is the borrower to pay me back, right? And in that sense, rates are higher. Maybe it changes some things, but fundamentally, you're looking at the same things. And then on the equity side, it really has become an income-driven market, right? And I think Jason really hammered that home well. It's about how much income growth you can drive at the asset level,
Sure.
right? And then I think, on the uncertainty side, going back to that idea, this is not a beta market. This is an alpha market now, right? You're having to deal with all of these things, higher financing costs, uncertainty on the policy side, obviously some macro questions. And, it's going to be about can you identify the assets, the sponsors? Can you operate the properties such that, you can drive that income growth that we're talking about that's ultimately going to be much of the return that we see in the real estate market, going forward.
I mean, something I had a takeaway that went across both as well is that, some of the opportunity sets are really kind of informed by other asset classes. What I mean by that is when we think about real estate secondaries, where you can step in, like you said, and be that liquidity provider. Jason talked about how that field was really built out of the GFC and taking cues from the private equity secondaries market that was really beginning to take off, at that same point in time, and having the benefit of being able to walk down the hallway and talk to somebody who is executing private equity secondary deals. And that informing, a new branch of what we do on the real estate side as well. And then for Rob on the credit side, talking about the improvements in flexibility on some of the terms, the ability to upsize a loan on a commercial real estate property, the ability to have the property owner go in and make value add improvements and still have that financing in place, that flexibility that wasn't available through, syndicated markets or through, traditional bank lending that the non-banks have come in to fill that role with.
Yeah, and it just speaks to the innovation that's occurring within private markets, right? And that's happened over time. And I think ultimately on the credit side, to your point, we've seen it in corporate credit that private credit's become a dominant player in that financing market. I think we're just scratching the surface on what's going to happen in the commercial real estate credit markets.
So it's an exciting time. Again, I think one of the big takeaways is the market is more calmed
Yeah.
maybe not comfortable.
Calm but not comfortable.
So
You got to keep some people on their toes.
We'll
you know?
take that with us. And we'll say thank you again to Jason and Rob for sharing your experience and expertise with us and with our listeners. Thanks for listening to this episode of the podcast. For more on the Private Markets Outlook, check the link in the show notes or visit futurestandard.com.